Welcome back to the Sure Sales Group Show, episode 46, and today I want to tackle the difference between fiscal policy and monetary policy.
Here on the show, we talk about real estate, sales, negotiation, marketing, entrepreneurship, buying, selling, renting, investing, and what it's taken us to grow from 2 employees to 20, from 30 million in sales to 130 million in sales in the last few years. Thanks for watching.
There's a whole bunch of conversations going around right now with buyers, sellers, realtors, mortgage lenders around interest rates. In last week's show, Todd Mummert's been stopping by talking about interest rates. Mark Pay was here talking about interest rates. And it's a very important topic and conversation because it directly impacts buyers and their ability to qualify for specific monthly payments. So I wanted to take it kind of one step deeper and go over, why these interest rates are what they are, who controls them, and what kind of controls some of the dynamics. And it all starts with the difference between fiscal and monetary policy. It's my opinion, if you're in business, you should know the difference between the two. And I think a lot of people get them confused. And I've heard people talk about them in a fashion that was kind of confusing and it didn't make a lot of sense. So I just want to break that down real quick here, and then we'll get to the interest rates. So fiscal policy is policy set by the national government. That's, the Congress gets together and they pass bills and legislation, typically around taxes and spending. Hey, how are we going to collect money and how are we going to spend it? And everyone's got an opinion on it. People don't like taxes. We spend too much. We tax too much. We don't do enough, et cetera, et cetera. That's what the government does. That's fiscal policy set by our national government. Fiscal policy. What's totally separate and totally independent of that is monetary policy. And monetary policy is set by the Fed. If you've heard say, hey, the Fed's doing this, the Fed's doing that. The Fed is the Federal Reserve, our central bank. Completely independent from anything our government's doing is this central bank, the Fed, which controls monetary policy. And what monetary policy is it's designed to promote a healthy economy and control inflation. And how they control inflation is with interest rates. So let me take a step back because I skipped a point. Another reason this is relevant is we have a new Fed chairman. It was Janet Yellen. Now it's Jerome Powell. His friends probably call him Jerry. Jerome Powell is the new Fed chairman, and he's been making the news quite a bit as these interest rates go up, because as the Fed chairman, who is the kind of the head of the monetary policy, he's controlling the interest rates in an effort to promote a healthy economy and control inflation. So quick thing on inflation, because that's kind of a mystery to a lot of people. What is this phenomenon known as inflation? Well, inflation is essentially you want to control the fact that prices for goods go up and the purchasing power of our currency goes down. We need to control that. We don't want the McDonald's hamburger to cost 97 US dollars. The price would be going up, and then how much is a dollar worth if 97 of them gets me a cheeseburger? So that's inflation. We want to control that, and how we do control it in this country with the central bank, the Fed, is through interest rates. This is very low-level stuff. Now, I'm not an economist, and I'm not trying to be one on the internet, so there's people who know a lot more about this than me. This is just the basic stuff, and I do think it's important to know the difference between fiscal policy and monetary policy. But to go a little bit deeper, the reason these interest rates are going up is Jerome Powell is saying job growth has been robust. It's been good. Jobs are growing, economy's strong. Consumer spending, also very good. People are spending more money, and that just helps the economy. And then people are getting paid more too. So the corporate tax restructuring probably helped with that. So all these things are good, and now interest rates are going up in an effort to control inflation. So what's really important about this is they said, Jerome Powell and the Fed said, there will be 3 interest rate hikes in 2018 scheduled and 2 more in 2019. Interest rates are going up. We've been talking about this in the industry for like the last 5 years because they've been so low. But now because the economy is doing really good, job growth, wage growth, consumer spending, interest rates are going up. They're already at 4-year highs. And why is that important? If you've had thoughts of buying a home and you know the interest rates are going up, the rate at which you can borrow money, time is not your friend in that instance. You probably want to buy sooner, apples to apples. If you bought this month versus you buy at the end of the year, this month you're going to be able to borrow money a little cheaper. If you're thinking about selling a home or making a move, hey, when interest rates go up, your house becomes a little less affordable. Someone who could qualify to buy your home when their interest rate is 4.5% might not be able to qualify to buy your home if the interest rates are at 5%, and they are going up. So this kind of big economic conversation around fiscal policy and monetary policy is important because it directly impacts pricing, inventory, the velocity of the market, buyers' buying power. It's a very complex issue. I highly encourage anyone interested in economics in general to watch Ray Dalio's YouTube video. Just Google Ray Dalio, How the Economic Machine Works. 20 minutes, he explains it beautifully. And I've always been appreciative of someone who can take a complex topic and break it down into something a little bit more simple so I can wrap my head around it. So that's all I have for today. Fiscal policy, totally separate from monetary policy. They have to work together to promote a healthy economy, but they're totally separate entities, totally different. I hope you learned something. Until next time. Oh, by the way, the Fed, the central bank, that's not actually who you're borrowing your money from. Their interest rates aren't what your loan rate's going to be. Kind of how it works is their monetary policy sets up the bond markets, which then sets up the consumer's lending rates. So the monetary policy changes, they're going to raise rates, that affects the bond markets, that affects the rates at which banks and investors are willing to lend people money to buy houses. So there is a little bit of a go-between there, and if you have any questions on it, I would be happy to refer you to some of our mortgage people who probably could explain it much better than me. And thanks again for watching.